This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 433 was produced on June 20th, 2024. I'm Eric Townsend. Rosenberg Research founder David Rosenberg returns as this week's feature interview guest. Rosie says the breadth just isn't there in the stock market, and the outperformance of the SPOOs is really just 3 out of the 500 stocks in the index.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, June 19th, 2024. The S&P 500 September futures were up 124 basis points, trading at 55.60. Upside accelerating with NVIDIA tailwind. We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The US dollar index up 52 basis points to 105.22. Continues to look for a breakout on the back of a weak euro. The August WTI crude oil contract up 282 basis points, trading at 80.71. Back above 80. We'll take a closer look at that chart in the post game with Eric. The August RBOB gasoline contract up 293 basis points to 246, lagging the oil price recovery, but will it confirm oil? The August gold contract down 30 basis points to 23.47, continues to trade in a range. Copper down 154 basis points, trading at 449, and uranium down 35 basis points, trading at 85.70. The U.S. 10-year Treasury yield down 10 basis points, trading at 421. And the key news to watch this Friday is the global flash manufacturing and services PMIs. And next week, we have the consumer confidence numbers, Richmond Manufacturing Index, new home sales, the final GDP, durable goods orders, and the University of Michigan consumer sentiment. This week's feature interview guest is Rosenberg Research founder David Rosenberg, with us taking a deeper look into the macro conditions in today's market. Eric's interview with David Rosenberg is coming up as Macro Voices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Rosenberg Research founder David Rosenberg. Rosie, it's great to get you back on the show. Let's dive in, starting with the economy. How do you see the picture? What's going on? What's the update since the last time we talked to you?
Well, I think the update is that the U.S. economy is slowing down precipitously. As we all saw, first quarter real GDP weakened to 1.3% at an annual rate. Of course, that was revised lower from 1.6 and was a surprise to the downside. And that is what we would have ordinarily labeled stall speed back when I started in the business in the mid-1980s. And looking into the second quarter right now, the data at hand looks as though we're going to come in somewhat even weaker than that. Our own model is saying roughly 1%. I know the Atlanta Fed is at 3.1, but I am sensing that data point is a little stale after the disappointing retail sales report that came out for May. The St. Louis Fed nowcast is actually at 0.9, and we're close to there as well. So let's just say that the view promulgated by Jay Powell at the podium at the press conference after the last FOMC meeting, when he talked about how the U.S. economy is strong and solid, I really think he was saying that with the lens of looking at the economy last year, when fiscal stimulus and the last leg of the excess savings file propelling the consumer, and of course double-digit growth in credit cards, that produced 100% of the growth last year, those three items collectively, and they are in the rearview mirror. So I think that we are now seeing the economy decelerate, and the question for the macro bulls would be, what is the catalyst that is going to precipitate a reacceleration in the pace of economic activity? I actually think that right now we're setting the table for the recession that got delayed but did not get derailed. And I think that a lot of those folks that threw in the towel last year on the recession call will be spending the summer picking up those towels.
David, I agree with you completely on the message that it feels like the economy is slowing, we're at stall speed or below stall speed. But back in the day, there was this theory that was supposed to be bad for the stock market. And of course, we're melting up to new all-time highs every day. What's going on? Is it the case that investors are not seeing the picture clearly, or is it a flows thing where it's just something in the market is causing this to happen? Why is it that you and I see something that apparently the market consensus doesn't agree with?
Well, when we're talking about the stock market these days, we're really talking about three stocks. We're not even the Mag 7 anymore. We're the Mag 3 or maybe the Mag 1, but we're really talking about NVIDIA, Microsoft, and Apple. And investors in those stocks likely are taking a very long-term view of this AI revolution, the generative AI revolution. And the question is whether it's evolution on the technology curve or indeed a true revolution. But I think that the reason why you're seeing growth stocks perform so well is because they tend to be the longest duration stocks. And hence, they are less sensitive to the vagaries of the business cycle. So when you're taking a look at the more cyclical parts of the market, the value area of the market, you look at the small caps, for example, the transports, the home builders, the economic sensitive sectors have peaked out and rolled over. And I think that is the economic message from the stock market. It's not coming from the fact that you have three mega caps that represent 20% of the index. It's really what's happening beneath the veneer. And so if you're looking at the breadth measures and you're looking at the dramatic bifurcation in the market, you'll see that there are cracks beneath the surface, but obviously not in those three particular stocks, which I think investors are just adopting a much longer term view that really doesn't have a lot to do with the near-term contours of what's happening with the economy.
David, let's move on to the two closely related topics of inflation and monetary policy. We had Jim Bianco recently make the call on our program that he thinks inflation bottomed already and is only headed higher from here. Fed clearly doesn't think that's the case. What's your take?
Well, Jim Bianco is a friend of mine, and I know that he has been on the inflation side of the debate for many years. Even before COVID. I don't know what his reasoning is as to why inflation is going to make a sudden resurgence. It was very clear as to why we got to 9% for 1 month back in the summer of 2022 on headline inflation. And it was rampant easing of monetary policy, bumping against a rampant easing in fiscal policy, and bumping against the disruptions we were seeing constantly in global supply chains. All the global supply chain measures have moved to or below the levels that we had before COVID reared its ugly head in early 2020. I don't see the supply disruptions. I know I hear a lot about deglobalization, but that's really something that will show up over decades. That impact is more glacial, and we'll see, what form it takes. But I don't see how you get inflation from what's happening on the supply side of the economy. And I'll come back to that. On top of that, the stimulus and fiscal policies in the rearview mirror. And we just came off the most acute Fed tightening cycle since the Volcker years of the early 80s. So I don't see where the case is for a reemergence of inflation. And in fact, what's very interesting is when you're looking at the inflation that's geared to the most cyclical parts of the economy, they've been deflating now for 3 months in a row. And the only thing holding up the CPI or the PC deflator has been the bump that we had, which is now over in insurance costs earlier this year, and the rental measures, which are taking their time slowing down, but they are slowing down nonetheless. I take a top-down view on inflation. In other words, being a macroeconomist, what you want to do is look and see where the pressures on inflation coming from. And you can only do that with two curves, aggregate demand and aggregate supply. And I know that when I talk about aggregate demand and aggregate supply to non-economists, their eyes just glaze over. But that's the only value from an economist, despite the fact that we're a bunch of fun-loving people. You hire economists because we're trained to draw these curves, supply and demand. We have to get the shape of the curves right. We have to get the movements in the curves right. But you can forecast the price of anything if you have a conviction or a call on how these supply-demand curves are moving and what their elasticities are. So I don't know what Jim's looking at. We have an economy right now on the demand side, which is growing barely more than a 1% annual rate. The Fed's own forecasts for the next several years hover around 2%. And let's assume that they're right, although they're rarely right. Where's the supply side of the economy? Well, when you take a look at multi-factor productivity and the expansion of the labor force, we have the supply side of the economy expanding between a 3 and 3.5% annual rate. And we have the demand side growing, call it 1 to 1.5%. So how do you get inflation when demand is lagging so far behind supply? When we had the big inflation in 2021, 2022, those numbers were flipped. We had very weak growth in supply and we had booming demand because of all the policy stimulus. That is looking at the situation in the rearview mirror. So what I'm talking about here is the reemergence of a disinflationary output gap. That means higher rates of unemployment, which is what we're seeing, and lower levels of industry capacity utilization rates, which we've also been seeing. And those are the conditions of what's otherwise known as excess capacity in the economy. And there really is nothing in practice or theory that leads you to higher inflation in that environment.
I don't want to try to represent Jim Bianco's reasons for thinking inflation has bottomed because I might get it wrong. But I can give you my own novice view, and maybe you can set me straight with what I'm missing, which is it seems to me like the biggest trend of the 2020s is increasing geopolitical risk. We're going to have more wars. My very simplistic understanding of macro is, hey, wars are always inflationary because first you got the U.S. government spending $60 to $100 billion at a shot to help other countries fight their wars. And then wars, they blow stuff up that eventually has to get replaced, and that's inflationary. What am I missing?
We had the onset of the Russian war in Ukraine back over 2 years ago. And inflation has only come down since then. We've had, I guess you could argue, the Israel-Gaza war and all the activity on the Red Sea from the Houthis, which of course has had an impact on shipping costs, but the underlying inflation measures have only been receding. So do wars create inflation? Well, regional wars don't create inflation. If we, God forbid, have a world war or we enter a world war, that is something that, we'd have to consider. But you're talking about regional skirmishes, and there's been no evidence in the past couple of years that that was the source of any inflation. The primary source of inflation was the breakdown in supply chains, and that was COVID-related, and it was China-related, and the boom in demand bumping against each other. So, no, I don't necessarily agree with the premise that wars are inflationary. It really depends on the type of war we're talking about and whether or not it's localized. So I don't know if I necessarily agree with that premise. The premise I agree with is my own two eyes. And it's hard for me to think about what wars have to do with the fact that when you read the Fed's beige book, and the Fed's beige book, which comes out every 6 weeks, and is the most comprehensive look at the U.S. economy by industry and by region. It's been published for 60 years now. And you read the latest beige book for May, and it was replete with a loss of corporate pricing power across the board, and especially in the retail sector, which is a dominant component of the CPI and the consumer price deflator. So tough to square the two. What's really happening here that's more important than the wars that you mentioned was this. Back in 2021, 2022, when the U.S. household sector was sitting flush with $2 trillion of a lottery ticket provided by Uncle Sam in the form of those stimulus checks, nobody seemed to notice that businesses were gouging them. That might be the only thing I ever would have agreed with Joe Biden on, that there was gouging. And of course, you saw it in the profit margin numbers, which were skyrocketing. And companies knew that they could raise prices because nobody cared. Everybody had their pockets stuffed with cash, and they didn't seem to mind or notice the price increases. Well, as the San Francisco Fed just reported last month, all of the $2 trillion of excess savings and then some have already been spent in the economy. The savings rate is already down to roughly 3%, historically low level from the normal 8% level we had pre-COVID. All of a sudden, people don't have that savings cushion, and they're noticing where the price level is. And they are feeling a lot of pain. Right now, the consumer sector is noticing that prices are just too high. And then we have to decide, you and I, as to whether we want to define inflation as to the prices that businesses want to charge their customers or the prices that their customers are willing and able to pay. And that was something else that came through, not just in the latest beige book, but every single one this year, which is that there is a consumer revolt, a resistance to current prices. And that's why pricing is not just slowing. In wide swaths of the retail sector, prices are being discounted. You could now look at that CPR report that just came out for May, and you look at the spread of areas of the economy. No, not insurance, not financial services, not education or health, but you're taking a look at delivery services and autos and furniture, major appliances, building materials, the stuff you can see, touch, and feel, apparel. Those prices are actually being rolled back. So that to me is what's really important, is that now consumers are feeling not just the inflation, which is a rate of change, they're feeling the price level. And companies are now being forced to roll them back. And all of a sudden, even though profit margins are still above their historical norm, they're starting to come down discernibly. And that to me is the inflation story. That is the overriding inflation story. There is widespread consumer resistance today and going forward over the current price level setting in the economy. And I think people will be surprised that we're going to morph into a deflationary environment. And I think that will be the big surprise to the markets over the course of the next year.
David, when Jay Powell pivoted dovish, whenever that was, 6 months or so ago, at one point in the wake of that decision, there was something like expectations of 7 or 8 rate cuts this year. That's come way down. Do you still think that there will be rate cuts in 2024? Will they happen before or after the election? And how many would you expect to see?
Well, look, the market was priced for more like 6 cuts. And It was a classic case, I suppose, of, the Fed playing the role of Lucy with Charlie Brown and the football. But the markets, I think, read a little too much. I don't think the Fed really did any more than pen in 3 cuts at the December meeting and the dot plots, and the market went and priced in twice as many of those. And then the Fed corrected that situation. I know they pivoted the other way, and now they're penning in 1 rate cut. I think that they'll move twice at this point. July is probably off the table. But if the CPI, PC deflator, and the economy continue to behave as they have very recently, if this is a trend and not a blip, then I think that they will be cutting rates at the September meeting. And I wouldn't be surprised if Jay Powell uses the Jackson Hole Symposium in August as a way to set the table for that. So I'm actually forecasting the first cut to come in September, November. December is up in the air. I think they'll go bang, bang, September, November, and then depending on what happens. But it's not out of the realm of possibilities that we do see 3 rate cuts. It may well be that the Fed's initial dot plots last December of 3 cuts, it ends up being what we see, just later rather than earlier. But the first cut I expect in September, and then in November, the election will be behind us. The FOMC meeting's November the 7th, the election's November the 5th, so they won't have politics getting in the way. So I'm thinking 2 cuts, possibly 3, as opposed to 1 or possibly 2. That's how I would draw the probability curve.
And then, of course, the election itself is the next big event after that. Do you have any thoughts on election outcomes and what they mean for markets? Biden wins, it means this. Trump wins, it means that.
Well, look, the reality is that investing around politics is a real mug's game, and I always recommend to my clients not to invest, at least initially, around the political backdrop, because what you see isn't always what you get. I mean, if you remember, everybody thought that the stock market was going to get slaughtered because the socialist from Arkansas, Bill Clinton, came into power in 1992, and the stock market ended up for the next 7 years was a one-way ticket north under Bill Clinton. And who knew that Bill Clinton, of course, being nudged by Bob Rubin, would shift to the right? He shifted the party to the right. And Barack Obama got elected once again, a socialist from Illinois back in 2008. Stock market did just fine under Barack Obama. And then we had Donald Trump 2016. The initial reaction was that, he was going to be disastrous for the stock market. Next thing you know, big tax cuts, deregulation, and the stock market takes off. And basically, under Joe Biden, the reality is, whether you like him or not, the stock market's done just about the same under his tenure as it's done under Donald Trump. But it's tough to really pinpoint that any of this had to do with who's in the White House. The market just did what the market did. Now, all that said, what's at stake at this election that could matter for the stock market is fiscal policy, because next year those Trump tax cuts hit their sunset. And so we could end up going back up to a 35% top corporate tax rate with a snap of a finger if Biden gets elected or Trump gets elected. I think that the outlook would be that we're going to get at least this ongoing lower corporate tax rate that he brought in back in 2017. So I do think that this time around there'll be a more negative reaction if Biden wins, only because I think the Democrats would be willing to let the corporate tax rate rise. I don't think back to where they were pre-2017, but I think they would have a more, shall we say, populist agenda towards providing the whatever tax relief towards the personal sector and low income, middle income households. What the stock market would like to see is corporate tax rates staying where they are or possibly going lower, and that's going to have a higher probability under Donald Trump. So you could argue that this election, strictly from dollars and cents, from what it means for the corporate profit profile, this one could be more important. But then we also have to weigh in, what's the composition of Congress going to be? So it's not just who takes the White House, but also will it be a sweep or not? So that's going to matter a lot, because whoever wins the White House, if they don't have Congress, it's going to be difficult to do anything outside of executive order, and you can't really change taxes under executive order. And so we have to pay attention to that as well. I mean, Barack Obama managed to get Obamacare through because in his first 2 years, it was a clean sweep on the Democrats. And the only reason that Donald Trump got tax cuts in was because the Republicans had a clean sweep when he got elected in 2016. So that's the other thing to consider, that it's not only who has the keys to the White House, but what is the composition of the House and the Senate. If there is a clean sweep by the Democrats, I think that it would be reasonable to assume that the stock market would view that far less bullishly than a clean sweep by the GOP, just based on the future of taxation in the corporate sector. The offset, of course, would be that Trump also wants to undergo widespread tariff increases. So you'd have to be very mindful of the companies in the United States that you want to own that have a high import quotient, because their margins might come under pressure even if their tax rate is cut because of what the import tariffs will do to their input costs. But outside of that, long way to say that this time around, I think I would be saying that a Republican victory, it would have to be a sweep, would be viewed more bullishly for sure than a Democrat win.
Let's talk about energy prices, which have a big impact on both the economy and inflation. In the wake of OPEC changing their policy around looking to phase out their production cuts, we saw a bottom around $72.50 on WTI just 2 weeks ago, and we've seen a $10 rally off of that low in the last couple of weeks. Where is this headed? Are energy prices headed substantially higher? If so, how long does it take for them to get there? And what is their effect on the economy when that happens?
Well, oil prices, out of all the commodities, are the hardest to forecast because there's so much politics that's involved. So you don't know. You can wake up next week and Joe Biden decides to release barrels of oil from the SPR and we're down $5. Oil is very tricky because of the political motivation that other industrial commodities aren't subject to. And to me, I'm looking at the chart and we're barely at the midway point of the range of, say, $75 on the low side and $120 on the high side. We're actually, you could argue, at the lower end of the range. I think that in a recession, oil prices will go down, but maybe not as much as people think, because there is a very strong supply curve that should help provide a more firmer bottom. But based on, I'd say, the outlook for the global economy for the coming year, I think demand is actually going to be pretty soft from a cyclical standpoint. And I know people talk about all the power needs that are related to EV and related to AI curve and so on and so forth, and all the power that's going to be needed. And I understand that. But I think that 80% of the oil in the United States from a consumption standpoint go into the gas tank. They go into the gas tank. We can dream up all the reasons why demand for oil is going to be firming and going up, but I don't think it's going to be happening in the next year. And in fact, you're seeing right now in the data that volume in real terms, volume consumption by the U.S. consumer is negative year on year. So what's happening is because consumers at the margin are so financially pinched right now that they're not filling up their tanks, okay, and they're driving less. And this is just the thin edge of the wedge. So at current levels, I'm actually moderately bearish on oil prices. Longer term, I think that you can produce a fairly bullish viewpoint based on global supply and demand. But right now, I would say that if we go into an economic downturn, you can bet your bottom dollar that U.S. retail consumption of gasoline will be going down, and that process has actually started.
Another commodity that's been perplexing me a little bit recently is copper. Now, normally we call it Dr. Copper. It's the measure of the economy. The fact that copper has been selling off pretty substantially, is down 15% from its peak just in the last few weeks, seems to jibe perfectly with what you said about the slowing economy, but it's exactly opposite what the stock market's doing. So how should we interpret this? Is this, why is copper doing this, and what happens next?
I had this in my daily about a month ago showing, copper today to nickel a couple of years ago. Nickel faced a massive short squeeze. For a while, it looked like NVIDIA stock. And then once the short squeeze was alleviated, it came back down to earth. And copper also just underwent a massive temporary supply squeeze, and that squeeze is now oozing out of the system. And it's coming back down. And I'm not so sure it has anything to do with what's happening with the economy globally as much as what's happening in the trader community than anything else. So I wouldn't read anything into copper now that you would have read into nickel a couple of years ago under similar circumstances.
David, let's move on to China. A lot of people thought that the key to the global economic recovery story post-pandemic was going to be when China got back up to full capacity. Then, of course, we've had a bunch of geopolitical developments. The picture's gotten cloudy. Do you think that China coming online is a major, gating factor to the economic recovery globally? And if so, what is it going to take for China to get the rest of the way?
Well, look, China right now is battling two different wars. There's the global trade war, and increasingly being put into the penalty box. And no matter who emerges victorious in the White House, they will be facing more trade sanctions in the future. And there's this prevailing concern among the industrialized world that China is attempting to export its excess manufacturing capacity and deflationary pressures to the rest of the world, and that is in the process of being resisted. The big part of the story is this ongoing implosion in the property sector, which is 30% of the economy. It is still deflating. Bad debts are still accumulating. It's not as bad as it was 6 months or 12 months ago, but it hasn't bottomed yet, and that is a debt weight drag on their economy. More fundamentally, China is really following Japan. Japan was the roaring economy in the 1980s when I started in the business, and peaked right around 1989, 1990, along with its stock market. But then its economy went through, we could argue, was more than a 20-year period of malaise. And the cause of the malaise are the things that are undermining China's growth potential right now, which is the need to mop up a real estate and debt bubble that burst. They both share that. We know what happened in Japan. In the U.S., we had it too, but it didn't take long to clean it up, which is the beauty of having a truly capitalist economy. And, a government that got its act together finally with TARP, back in early 2009. But Beijing doesn't seem to be coming up with a lot of answers to help mop up the problems in the property sector. They're very slow to stimulate fiscal policy. This would never happen in the United States. And they're also being undermined by declining population, which, of course, was a Japanese disease as well. So I'm looking at Japan through the lens of an economy that is into a secular economic downtrend. Not negative growth, but very low mid-single digits growth. The era of China being a major force propelling the global economy, those days are long gone and they're not coming back. So I think that China is in a structural economic turndown. That process has already started, and it's being reinforced by the problems surrounding the real estate sector and the need to mop up the bad debts that are coming out of the deflation in the property market. And we all know when we've seen these real estate deflations before, whether it's Japan or whether it's what happened in the US under real estate deflation in the late 1980s, or again back in 2007, 2008, 2009, these take a long time before you move to the other side of the cycle. like I said, you couple that with the real sluggish demographic backdrop in China, and you have the makings of a very slow growth economy. I'm not making a comment on their stock market. Their stock market is very cheap. Of course, you talked before about geopolitical risk. There's a ton of it in China, so maybe there's a reason why their stock market's cheap. But their economy is going to be bouncing along the bottom for a prolonged period of time.
David, final question. Is there anything else that you'd like to add in terms of sectors to focus on or investment strategies that our audience should consider?
Yeah, I'll just finish off with maybe trying to be a little bit more positive. There are areas to put money to work. There's not a forecast that's telling people to run for the hills or go out and buy canned tuna, baked beans, and barbed wire. It's really being more thematic in nature. I think that the AI revolution, or you can call it evolution, is real, but there's too much uncertainty over what the true size of this market is going to be. And I think that investors, once again, as they did with fiber optics and the like back in the late 1990s, are probably overestimating what the AI revolution is going to deliver in terms of profits. So I'm a little wary about technology and especially what's priced in. But as you said before, this is a world with skirmishes. It's a world with regional wars. It's a world where military budgets are being built up everywhere. So defense aerospace, I think, is a secular theme. I think especially coming out of COVID, things like food security and cybersecurity, that is a major theme, an investable theme. I like many parts of the emerging market world. It's not a homogeneous space, but I think India and Mexico, you can argue Korea, are all places that look very attractive, much more reasonably priced than what we have in the US right now. And I would say that along with that, Japan, despite its stop and go economy, the lingering impact of Abenomics and what that's doing in terms of prompting companies to force cash off the balance sheet back to shareholders. You look at the all-in yield in the Japanese stock market, it is very alluring. And that, to me, is a buy and hold. If there is a buy and hold out there, it's the Japanese stock market. So there's areas out there that you can put money to work. On top of that, I'm still a big fan of what I call the bond bullion barbell because I love alliterations. I think the Fed will be cutting rates. I think that future disinflation or deflation, you see, you brought up my friend Jim Bianco. That is the consensus. The consensus is that inflation is going to be sticky. And I think the surprise will be that it will not be sticky. And I think that the Treasury market will be a very good place to be as rates decline and the prices of these bonds rally. I think bonds will be delivering equity-like returns in the coming 12 months. And I think that once the Fed starts to catch up to other central banks in terms of their rate cutting, the bull market on the US dollar will come to an end. And that will be very good news for gold, silver, commodities in general. And so that's another area that I think you want to start chipping away at.
Well, Rosie, I can't thank you enough for another terrific interview. But before I let you go, I want to talk a little bit more about Breakfast with Dave, the newsletter that you've been writing. I don't know, is that the longest standing daily newsletter in the history of the finance industry? It feels like it is. It seems like forever. But for anybody who doesn't know, tell us the history of it. And more importantly, you, for most of your career, worked for big banks that kind of constrained what you do. You've now gone on your own with your own firm, giving you the freedom to both tell the truth and also add some new products. So let's talk about not just Breakfast with Dave, but what else you've got in the works.
Well, I started my daily back in 1998 when, the internet was really just getting going. And at that point, there was no other daily around. And it did give me instant notoriety. And it's ultimately how I managed to make the move from Bank of Montreal to Merrill Lynch. And so, yes, it's been a staple. It's not the only thing that I do. We have 12 different products, including my own webcast series. And we have different strategy documents. But I really pour my heart and soul out in the Breakfast with Dave every single morning. I get up at 4:15 a.m. I jump out of bed. I have a double espresso, and I am just raring to go. because I have a passion for what I do, and I love the financial markets, and I love connecting the dots between what the economy is doing and how to formulate a cogent and coherent investment strategy out of it. So I don't even consider what I do, and I haven't for many, many decades. I don't consider what I do a job. I guess became a career, but it's really, for me, it's a passion. And as I said, there's a whole lot of other things. I introduced a whole suite of products. I hired a whole strategy and economics team, and we cover all the regions of the world, and we cover all the asset classes. So we don't just do the daily. And the daily is there to help investors get through their day, whether it means sounding smart to your clients so that you're informed, or it means weeding through the noise. But the daily Breakfast with Dave is there to help investors get through their day, or maybe get through their week. It's really there to clear the air and to navigate all the noise that's out there in the data and the markets. You mentioned about starting my firm in early 2020. People were telling me years ago that I should have done this, and maybe I should have done it earlier. I still think the timing was right. And when I left Merrill Lynch to come back to Toronto in 2009, the opportunity to work at Gluskin Sheff, which was at that time one of the real premier fund managers in Canada, to work 12 years on the buy side after so many years at big banks on the sell side, and sitting down with portfolio managers and a CIO every single day and learning what money management and risk management is all about. I think if I started this after I left Merrill, it wouldn't be as valuable to investors as it is, because I realized what's most important is not your base case scenario. That's what most Wall Street economists believe. What's your base case scenario? Of course, you need a base case scenario, but you have to scenario build. And I learned very quickly at Gluskin Sheff, which I'll tell you right now, I learned more in the 12 years there than I did in the previous 25 years in my various incarnations at the big banks. And what I learned that was most valuable was that if you don't have a plan B, you don't have a plan. And I learned that for institutional investors in particular, that their brain is one giant probability curve, and that curve shifts. And even though your base case doesn't shift, if your plan B becomes plan C and plan C becomes plan B, you've just altered the whole risk return profile for an investor without even changing your base case. So that's really what I learned, was how to, as an economist, how to really be a more effective cog in the investment decision making process. And you're right. When you're working on the sell side or the buy side, they're all selling product. You work at a big bank, you're selling product. You work at a big mutual fund, they're selling product. And it's just a relief to just be able to sell my thought process, my ideas, my forecasts, as opposed to attaching it to a financial product or a particular view that your firm is investing around or not investing around. So it's been empowering. And I never allowed my superiors to change my view. I've been pressured a lot. I was a bit, shall we say, a bit of a pain in the ass to management where I worked, because I would basically stand my ground. And that's when you get into a situation where your own views might conflict with what management wants, because their business is to sell financial product. I'm not in that business anymore. I'm here to provide my views. And you don't have to adopt my views or accept my views, except that I do put a lot of thought behind them. And whether they're right or wrong, my hope is that they give investors things to think about that they otherwise would not think about. And just finally, to answer your question, yes, if you want to find me, you can either head into information at rosenbergresearch.com. It'll take you right in. I'm willing to give everybody on this call a free 1-month trial of everything that I do, all 12 products, including the webcast. And you can also just Google Rosenberg Research and it'll take you right to the website.
Well, David, my favorite part of your new job is that the buck stops with you and your bosses can't get in the way to withhold the freebies for our listeners. So, folks, if you didn't hear that, it's not just Breakfast with Dave. It's a free, full 1-month trial of all of the Rosenberg Research products. I don't think you can possibly go wrong unless you fail to take David up on that very generous offer. Patrick Ceresna, Nick Galarnik, and I will be back as Macro Voices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Dave back on the show. Now, joining us again in the post-game segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. Now, if you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over David's picture saying, looking for the downloads. Now, Eric, let's cover crude oil.
EIA inventory was delayed by the holiday, so nothing to report there. In the last few weeks, we've been from the high back in late May all the way around just over $80, down to the $72 bottom, and all the way back up now to over $81. So we're back above that late May high. I'm not a buyer here. I don't think that the big structural supply-demand imbalance that I definitely still predict is coming. I think it's still probably a couple of years off. Right now, in this moment, the market is more than adequately supplied, but there's so much geopolitical uncertainty that you never know which way the next move is going to go based on whether the next thing to happen is an escalation or de-escalation of geopolitical risk.
Now, Eric, I get your bigger macro view. I also think it's going to take a while for a really big upside on oil, but I'm looking at it much more short-term technically. That was definitively a short-term bottom formed when it went to retest the year lows. And since then, we've had a pretty strong 10% rally off the lows. And there's constructive price action, including some reactions in gasoline to start to confirm this. Now, I'm not yet looking for the next big bull market here, but this, if this ends up becoming not a short-term low, but an intermediate low, and we see any short-term selling immediately get bought on dips, particularly if the bulls can keep this above the $78 level, keeping like oil corrections down to $2-3 on the downside. If we can see that kind of a consolidation, it may open the window in July for a retest of that high from April around $86 to $87. Now, what's interesting is that the energy stocks have not really responded to this yet. So it'll be interesting to see if the coming weeks a trend starts to develop there. Nonetheless, let's move on to the S&P 500. Nick, I want to get you involved in this conversation. Let's just start off with you talking about what levels you're watching on the S&P.
Yeah, Patrick. So right now, SPX has a spot price of approximately $54.80. The implied move for the July 19th monthly OPEX is plus minus 130 points. Therefore, the upper implied move is 56.10, and the lower implied move is 53.50. Right now, we have no key resistance as we're at all-time highs, and we have key support at 5,400. I'm inclined to think we see a run further to the upside a bit, perhaps, but it's important to note seasonality right now. So just for reference, in election years, the median return for August, September, October are 0%. Whereas following the election, November, December, January, they're about 5.3%. Also to note that July, statistically over the last 100 years or so, has had the strongest period of market performance of any month of the year since 1928. And the Nasdaq has delivered a return on average in July over the last 16 years of 4.64% return. So interesting to note the seasonality overall right now. So I think we're going to see perhaps a push to the upside into July, followed by a flat-ish segment into the election time period.
Interesting observations there, Nick. I also think that on the short term we can go higher, but the interesting thing is that we're entering what I think is the parabolic phase of the rise, and what it might be is that it might all be pulled forward to these last weeks of June, where that big upside is, and July may see it already peter out because it just seems to be accelerating here. So on page 4 and 5, I wanted to just highlight two things. First of all, S&P just ripping to the upside, but the upside is coming on deteriorating market breadth. So looking at the market breadth to the start of the year, we were at 90+% in January of stocks participating on the upside. By March peak, we were at 85%. By the May peak, we were at 65%. And here we are with the S&P 500 ripping to an all-time new high with new momentum, with only 49% of stocks participating on the upside in the S&P 500. So we have continuously divergent market breadth happening, and that's largely because this rally has literally become focused on simply the handful of mega cap stocks that have gone parabolic, and the number one of that is Nvidia. Obviously, Microsoft and Apple both contributing to this, but Nvidia has been the AI story and the one that has really driven this, and it's such a behemoth that and a big market cap component of this market that it is alone carrying this S&P 500 higher. And this is why I am going to make the call that where we see Nvidia's peak, it's going to be the high of the S&P 500. We already have seen the peaks come in on many other indices. Take the Russell. The Russell is nowhere near its March highs. We take the equal weight S&P 500, where it equal weights all of the components, not making new highs. You take the Dow Jones, which is price weighted, nowhere near its March highs. And so you have a scenario where this index is literally just being carried by this. So the question, of course, is, will Nvidia peak? And, a lot of people are like, oh, you can't short this stock. Of course you can't short it. But the point is that these excesses almost always correct. And I think the best thing to do is refer back to Bob Farrell's 10 rules of investing. I want to just highlight 5 of them that I think apply to today's market really well. And it's an important one to always remember. Excesses in one direction will lead to an excess in the opposite direction. The next one is, there are no new eras. Excesses are never permanent. The next one is, exponential, rapidly rising or falling markets usually go farther than you think, but they never correct by going sideways. The next one is, the public always buys the most at the top and the least at the bottom. And the last one I want to reference is, fear and greed are stronger than long-term resolve. And really the point of this is that Nvidia is in this exponential phase. And on the chart, I'm showing the slope of the acceleration. And it literally, we could see Nvidia within even a couple of weeks hit 150, 160. I'm not here calling the market top today, but it is in the exponential phase. And when Nvidia ultimately reaches that point of exhaustion, it's not going to correct sideways. And when Nvidia blows off that top, it's going to be the same time the S&P 500 puts in its top. And so it'll be interesting to see, Nick, whether or not that happens going into July, or maybe it does last into the first few weeks of July to kind of put that scenario in play. Anyway, let's move on to the Nasdaq. What levels are you watching on the Qs?
So right now in the Qs, spot price is approximately 486. We have an implied move for the July 19th monthly OPEX of plus minus 17 points. Therefore, the upper implied move is 503, and the lower implied move is 469. Right now, we have no key resistance as we're at all-time highs, and key support resides at around 460. As you mentioned about the market breadth, one thing interesting to look at right now is the total value of the S&P right now is approximately 44 trillion. And right now, the top 10 companies comprise almost $20 trillion, which is kind of insane when you think about it, because the top 10 companies essentially are almost equivalent in value to the remaining 490 companies. So I'm not so sure it's really important to look at the breadth overall, because as you said, the larger names like Nvidia, for example, if they falter, the market will have a very tough time remaining higher. So again, my thesis is that we see a push toward the highs into the middle of July, followed by a stagnation period into the election cycle overall. If you're looking to hedge your portfolio and you want to remain long, it's never been cheaper really to hedge your portfolio overall. So it makes sense to take some risk off the table by buying some insurance perhaps, if you want to try and chase that incremental upside.
Yeah, to your point, when we look on page 8, that volatility index, the VIX remains at the 12 handle right along the year lows. And so right now, no one seems to be worried about anything. It's a complacent market and volatility premiums are very low, making those insurance premiums very cheap. What levels are you watching on the VIX?
So right now with the VIX at a 12 handle, we can expect to see intraday top to bottom moves of about 0.75%. Over the last few weeks, we've seen very, very muted movement overall intraday. And as we mentioned, if the mega caps do start to falter overall, the market should roll over a bit, and that would cause a correlating spike in the VIX itself. As I mentioned previously, insurance right now is very cheap looking out to September, October, November timeframes. And if one is to be inclined to remain long in their portfolio in its entirety and not take any profits off the table, it would be wise to probably buy some insurance. Now moving on to page 9, we have the US dollar index. Patrick, what are your thoughts here?
The US dollar continues to show strength. The US dollar yen heading up to 160. In spite of all the yen bulls out there, it's resiliently climbing higher. At the same time, you have the euro breaking down because of all the political pressures. The US dollar is finally starting to turn up here. Watching that high from a week ago around the 105.50 is going to be really interesting. If we see a proper breakout in that, the next resistance level is at 106.5, and then you can really see a potential US dollar bull market really ensue. What's interesting is that will the dollar rising correspond with inevitably some sort of risk-off cycle in the markets? And so if the markets rip higher for weeks to come, maybe the dollar stays sluggish a little bit, but it'll be interesting to see whether a US dollar strength lines up with that.
And moving on to page 10, we have that gold futures chart. What are your thoughts here, guys?
Well, we're in a sideways consolidation, and seasonality in gold works against us until the end of August or so. So there's a good argument to be made that we're just going to continue to consolidate sideways. So where's the bottom of that consolidation range? Where should you be buying the dip if we get it? The continuation chart would say 2285 is the number. That level doesn't exist on the contract chart. The contract chart says 2269. That's the 100-day moving average. And it's a fairly sharply rising 100-day moving average. So that number is going to get higher. Now, I can say with confidence that in crude oil, when the contract and continuation charts don't agree, it's the front month futures contract and the contract chart that's the one to follow. I don't know whether that carries over to gold. If it does, that would suggest that 2270, maybe 2275 by the time we get there is the number to target as to where the bottom might be this summer. There's a good argument to be made that we're going much higher, but probably not until after Labor Day.
My overall macro stance is I'm bullish on gold. And the interesting thing is that this consolidation is normal. Whenever you have a rise, there's always a secondary corrective phase where it backfills and retraces that prior rise. And we're in the midst of some sort of a correction. That correction, in my mind, can definitely head down to that level you were mentioning, 2269, 2250 is even possible. I think old dips should be bought. And inevitably, when the right catalysts appear, then gold should have a continuation on the upside, but right now expecting it to do a little bit more of a grind, and we'll be looking for where that next buy on dip really shapes up.
Moving on to page 11, we have that uranium chart. Eric, what are your thoughts here?
Well, I think the market is trying to find a bottom here, or I should say I hope it's trying to find a bottom. Several of the uranium mining shares fell below their 200-day moving averages, and most of them then recovered. The charts are still looking kind of risky, though, actually quite risky. The key to this is when the very illiquid and frankly easily at risk of manipulation spot market for uranium, when that market starts to move with some momentum and some volume to the upside, that's when the next really big leg in this nuclear renaissance story is going to take off. But the thing is, the rumor is the buyers just aren't worried about this. They think the price is about to retrace to the downside, and they're going to be buying their uranium at the end of the summer at $50 or something. I think they're going to be proven wrong and badly wrong, and they're only going to be injuring themselves. But they can easily afford to just take the summer off and go on strike and not buy anything. If that happens, there's plenty of room, especially if there's any kind of hiccups or air pockets in the broader market. There's plenty of room for these stocks to take out their 200-day moving averages to the downside. If that happens, the charts are going to start to look really ugly.
Eric, when looking at that Sprott Uranium Physical Trust chart on page 11, it had a very aggressive sell cycle that was very much driven by the closed-end fund and not really reflective of what was happening in spot prices. It was trading at a material discount to where spot prices were, and now we're seeing that mean reverting on the chart. And therefore, I don't really want to technically weigh in on the little rally we had here in the last week. But what will be interesting to me is when will we see that lows are being established and that the spot prices start to turn up. And right now that's not there, but I generally remain quite bullish uranium, looking for the next continuation pattern to break out at some point, which it hasn't yet, but it'll be interesting in the month to come where that signal comes. Finally, I wanted to wrap up on page 12 though with the U.S. 10-year Treasury yield. And we put in last year that high near the 5% yield. And this time around, we hit about 470 on the yield back in April before it started to roll over. With the fact that we're seeing inflation calming down and seeing weak economic data, it's entirely plausible that these are going to be the highs of the year for the yield. It's not that there can't be a bond bear market in the years to come, but I think at this point, the 10-year Treasury yield is a bit of a safe haven during the upcoming period. And so I think having some of these treasuries, I'm not really looking for an extraordinary bull move, but I don't think there's much downside here in picking up this yield. And it'll be interesting to see whether we see yields make it down to 4% or lower in the months to come.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, as well as the chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. And you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @Eric S. Townsend, that is Eric spelled with a K, and follow Patrick @Patrick Ceresna. On behalf of Eric Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.